If you buy a house and you're comfortable with the payment, down the road, your mortgage might be worth zero and your house will never be worth zero. That I can make a prediction. My son had his own bedroom, a backyard, close to schools, a safe neighborhood, across the street from a park. You know what I mean? These are the things that I was thinking of.
If you have been told that right now is the worst possible time to buy a property in Ontario, I need you to stick with me for the next 45 minutes because the numbers actually tell a more complicated story than what you're hearing in the headlines. The average home price today in Ontario is actually less by about $100,000 compared to its peak in 2021. Inventory is running at twice the long-term average. You're able to negotiate with sellers. Sellers are motivated for the first time, able to put in conditions back in again. And yes, the oil prices have spiked because of the Iran war since March and definitely had an impact on the inflation picture. So in a market like this, what do you do? It's a market that presents opportunities, but at the same time is uncertain. What do you do? My guest today tracks this for one of Canada's largest residential lenders. He runs a platform called the Morning Brew that thousands of real estate professionals tune into and rely on to understand what the Bank of Canada is doing. And he's here today to help us separate the noise from the signal. And his name is Bruno Valko. Valko is the Vice President of National Sales at RMG Mortgages, a division of MCAP Financial Corporation, one of the largest non-bank residential lenders in the country. He sits at the intersection of Canadian monetary policy, bond market, and the real file-level decisions that millions of homeowners make every year. He is the host of the Morning Brew, a rate watch platform that thousands of real estate professionals across the country rely on to decode what the Bank of Canada is actually doing. He's arguably the clearest translator of the Bank of Canada working in our industry, and his framework that is built around three pillars, inflation, jobs, and GDP, is one that I'm going to ask everyone who is watching, whether you're a homeowner or a real estate investor or looking to get into the housing market, to watch and internalize. Bruno Valko, welcome to Streetwise Wealth.
Thank you very much for the invite. I appreciate it. I appreciate the words. Thank you.
We're excited to have you here with us today. Bruno, before we dig into the data, I'd love to ask you a question. You've built an entire national following by doing one thing, making the Bank of Canada's, numbers and data feel really, really simple for everybody. What most people don't realize is how much work goes into creating that simplicity. What is the one thing you would say that about your job that people in our industry would be generally surprised to know about?
So my goal, as you indicated, is to look at what the data is. And the thing we have to understand too is the Bank of Canada, when they do communicate, and I do follow them, they do communicate in a pretty simplistic way. I mean, they have a singular mandate, which is inflation being low, stable, predictable, in and around that 2%. They make that quite clear. They make their GDP monetary policy report predictions quite clear, what they expect it to be this year and next year, and so on. So I think we're fortunate in Canada that we have a bank that does keep things pretty simple. My goal is to educate, as you said, mortgage professionals in Canada in a way that's understandable. And as you said, I do keep things, in my opinion, understandable so they understand what is happening. I don't make predictions because it's impossible, in my opinion, to do so. I often, look at Jerome Powell. Jerome Powell is the head of the Fed in the United States. He's probably the most powerful central banker in the world. And he'll mention the word uncertainty numerous times throughout his press conferences on how things are uncertain. So if Jerome Powell is uncertain, the most powerful banker in the world, it's very difficult to make predictions. But what we can do is we can look at, to your point, the data, and then kind of rationalize where we're at with interest rates, and you can make your own decisions in terms of what your expectations are.
Bruno, you've watched various market cycles up close, the 90s, the 2008, the 2020, when the rates were close to zero, and the 2022 spike, and now where we are. When you look at what's happening right now at this time of recording, April 2026, with the oil shock layered on top of an already weak economy, what does this remind you of? Like, does this remind you of any cycle that you've seen previously, or most importantly, what doesn't it remind you of?
Well, I mean, we've had these oil price shocks very recently. I mean, remember the unfortunate onset of the war in Ukraine, which was in 2022. Oil went to over $100. And at that time, we had very elevated inflation. We often heard the word transitory in the sense that it would be transitory. But then in 2024, the Bank of Canada, together with the Fed in the US, started increasing rates. And that was, I think, June of 2024. So we had these shocks in prices very recently. The difference, I guess, in 2022, the onset of the war in Ukraine and the oil spike price that happened then, was we were in an economy that was doing quite well. Whereas now, when we look at, GDP in Q4 in Canada last year, 2025 Q4, it was negative. So that's a concern. And now on top of, we've had some job losses. Your viewers may be looking at that when we get the Stats Canada reports on jobs. We lost some 95,000 jobs in Q1 of 2026. On top of that, to have this spike in oil prices is very difficult for Canadians that are now, when you fill up your gas tank and now you got to pay an extra $30. If you're doing that once a week, I mean, $120 a month. So the current situation with an economy that's been struggling with the trade agreements in the United States, we've got a lot of reasons. And then, of course, you've got the war in Iran, which you mentioned. I mean, now that the war in Iran has started, what do you get? The war in Ukraine, spike in oil prices. You get a war in Iran, spike in oil prices. The challenging situation now is it's a little bit different because 20% of the world's oil travels through the Strait of Hormuz, which Iran has shut down. Now the Americans are also saying it's shut. So if oil can't pass through that strait, 20% of the world's oil, that leads to a supply issue. And when you have a horrible supply issue like that, 20% of your oil, that supply, the demand is still there. I mean, we all need to get to work. We all need to drop our kids off at school and so on. You're going to put gas in your car. It's going to take money out of the economy. And because of that supply issue, the price goes up. But the demand doesn't really change. It's hard for people to say, okay, I'm not going to drive so much. I mean, they might not take a driving vacation or so on, but essentially it's like food and gas. You kind of need to do it. And this situation with an economy that's struggling on top of these oil price shock, which is inflationary, can be a little more painful.
Okay, let's talk about the three pillars that you typically cover, the inflation, and you've touched a bit on that, the GDP and the job market, and then chat a little bit about what does this mean in terms of rate decisions. And I know you don't make predictions, but from a decision-making framework, what does it translate to? So the first question is, are we actually, for viewers who are watching right now, is inflation back, or this is just one indicator? Because I know the Bank of Canada uses three indicators for inflation, right? The core, the trim, and the third one. So is this just one of the indicators, and the others are fine? Or is it like, should we now freak out that inflation is coming back? Is this temporary? Tell us a bit more on what your thoughts are on that front.
So the three that the Bank of Canada looks at is they look at the headline number, and the headline number came in at 2.4. And that was to some extent good news, even though it came in at 1.8 in February, it came in at 2.4 in March. So that is a big increase from February. You mean, I'm sure Bank of Canada and everybody's a lot happier, of course, at the 1.8. The 2.4 was, as you discussed, because of that energy cost. So gas, I think, was an increase of 21%.
Wow.
Up until March, energy has been a downward pull on inflation, the headline number, because gas prices have been kind of coming down, energy prices have been coming down. So a little bit of a downward pull, where now with this oil price shock, they've been an increase. So the headline number 2.4, I mean, in December, I believe we were 2.4. So it's not overly alarming, even though the Bank of Canada has that 2% target. If you go in on their website, their range is 1 to 3%. So that's within that 1 to 3%, 2.4. The CPI trimmed, which is the other one, that's a core number. So it strips out food and energy. And the CPI trimmed is very valuable because it takes away the top 20 and bottom 20. And it looks at the middle 60 readings, right? So it looks at the middle 60, the beefy part, so to speak. And that came in at 2.2. And that was the lowest reading in March since March of 2021. So for 5 years, that was the lowest reading. So that was extremely good news. And then the CPI median number came in, I believe, at like 2.3%, which was at consensus, which means at market target. And whenever you look at these readings, you always want to gauge it to what the market is expecting. So the market was expecting Canada to be at 2.5, I believe. We came in at 2.4, which is great. They were expecting the CPI trim to be at 2.3. It came in at 2.2, the lowest in 5 years, which was also good. So the inflation numbers that came out for March, I don't believe were alarming for anyone in terms of what they came in relative to what the market was expecting. So I looked at those inflation numbers and thought, you know what, that's pretty good news, really, in the sense that the numbers did not come in overly elevated.
Okay, and what about the jobs? Where are we with unemployment right now?
So we get the job numbers from Stats Canada, and unfortunately, I mean, the job market, and I'm sure your viewers would, see this. We lost 95,000 jobs in the first quarter of 2026. So that's definitely not good news. Certainly there's work that needs to be done on the job front. The trade dispute back and forth with the tariffs and our largest trading partner being the United States and having some trade disputes with them, and they're renegotiating the trade agreement. But with manufacturing has been struggling in Canada. And when you talk about GDP, which would be your next question, well, manufacturing is a big part of GDP, as is consumer spending. And consumer spending, I think, is 54% of the overall GDP number. And when people are losing their jobs, that's a problem for consumer spending for obvious reasons when we have this job loss. So they are kind of tied together. Also, gas prices skyrocketing. If people have to spend an extra $150, $200 a month in gas, which they have to spend because they have to get to work, they have to do those things, where are they going to spend less money on? Are they going to cut their spending in other areas? And that would be the real consumer spending that would be a concern, because are you going to cut your spending in other areas because you're putting so much more money into your gas tank? And to your point, is this temporary or not? I mean, I can't answer that question because who knows when the Strait of Hormuz, which is a very important strait. A lot of people didn't know about this strait, but this strait is 20% of all oil passes through in the world, passes through that strait. So will it open? We were given news a few weeks ago that it was open, and, oil prices went way down, but now oil prices are back over $100 a barrel because it unfortunately remains closed, and that's a supply issue.
Yeah, it's an interesting landscape indeed. Real estate represents, I think, 13.2% of
Yes,
GDP.
real estate, that's the top three. It's real estate, manufacturing, and consumer spending. And real estate, I'm sure we'll talk about in a minute, has also been lagging in terms of sales in Canada.
Yeah, and I saw a recent chart in one of your presentations, Bruno, where you showed that consumer spending, which is 54% of GDP, has declined for the first time since Q3 of 2025. So there seems to be pressure on that front. You've got GDP declining, you've got unemployment and inflation ticking up because of oil. But what does this mean from a decision-making standpoint for the Bank of Canada? Do they because they use rates to stimulate or slow down things? Like it feels like it's being stuck between like two rocks right now.
Well, in Canada, remember, the Bank of Canada has a singular mandate. The singular mandate is to keep inflation in and around that 2% mark, within that 1 to 3. They believe that if inflation is 2%, meaning those three main categories, then everything else falls into place. We get investment, we get jobs, we get everything. So that inflation being in and around that 2% is critically important. Now, when they did their monetary policy report, I believe, or their news conference after the announcement, which was only yesterday, that inflation remained anchored, I believe, that's the term. Tip Macklem, who's the governor of the Bank of Canada, I think he used that term, that it remains anchored. So that was good, even though it increased from 1.8 to 2.4. So inflation is very important, and that's the most important thing in Canada. The Fed, on the other hand, has a dual mandate, which is maximum employment. Doesn't mean like zero unemployment. It just means the maximum amount of people working versus the 2% inflation. So they also have that 2% target, but they also have that dual mandate of employment where Canada does not. So we got to keep a very close eye, first and foremost, in Canada, in my opinion, on inflation. But we also got to keep a close eye on the United States because we are very much aligned in terms of our, direction. When I look at the last 10 years, where the Fed goes is where the Bank of Canada goes. So we kind of do follow the US in terms of directional trajectory of our central bank rate.
Yeah, I saw a chart where you've explained this, and I heard you say that there is a high chance of a rate cut in the US by December 2027, where here in Canada, like some of the banks are forecasting a rate hike here at home. So should we take these forecasts seriously, given that Canada typically follows the US and we haven't seen them at any point diverge, like in terms of direction?
So the CME Fed Watch is the tool that I look at, and that's the market. So that's what is the market's expectation in the United States. I don't the economists and so on at the banks. I don't ever pretend to be smarter than them. They have their decision-making processes. Again, I don't make predictions because, again, it's very difficult to do so. A social media post from the president of the United States could change things drastically from one day to the next. We've seen it. I mentioned they announced the Strait of Hormuz was open. Oil prices went down. Stock market went up. Bond yields came down. Bond yields are where we price our 5-year fixed rate mortgages. So, everyone's got their rationale behind what their expectations are. I look at things very simple. And the simple thing I would look at from my perspective is just basically if the United States lowers, and if that does come to fruition, we don't know if it will. That's just the market predicting. And that may or may not happen. They may not. They may actually increase. And then all of a sudden, we may increase. We don't know. But the market expectation is that they decrease by the end of next year for the most part. And anyone can go in on CME Fed Watch and look at that. So the argument would be, well, if the United States does decrease, will Canada go in the opposite direction? Because that will impact our dollar. And our dollar right now is hovering in and around that 73-cent mark. Can we afford, given the struggles we have in our manufacturing sector, to have a dollar that skyrockets? Because if we increase rates and the US decreases rates, our dollar relative to their dollar might very well skyrocket. If it does go way up to 85, 90 cents or whatever, what does that have? What are the implications of that kind of a dollar relative to our manufacturing sector? So obviously, that weighs into many, many, many different decision-making scenarios. But again, the market is predicting, CME Fed Watch, that's the market, not me. The market is predicting that the U.S. cuts rates. So again, you got to think, will Canada increase? And I did show a chart when I did the presentation that you were at that showed the trajectory of the U.S. Fed funds rate together with the Bank of Canada rate, both central bank rates. And you can see how they, for the last 10 years, directionally are in the exact same direction.
Yeah.
Ours may be deeper than theirs or vice versa, but directionally, in the last 10 years, they're the same. So historically, we've moved in the same direction. To think that the U.S. will cut and we increase would be contrary to what we've experienced over the last 10 years.
Yes. For everyone who's watching, the website that Bruno mentioned is super helpful for you to understand what's happening in the US. It is called CME Fed Watch. We're also going to have that link available to you on the Streetwise Vault, so you can easily find it. Bruno, let's talk about affordability. You've done a piece of math that I believe every buyer should take a look at. So you've shared that the same house is now, on average, is worth about $100,000 less than what it was in 2021, and the payments haven't changed much. Tell us a little bit more about your analysis and this particular affordability piece.
So what I do, and I call it like a then versus now. So I look at what are the average prices. Now, markets will vary across Ontario. Ottawa might be different than a condo in Toronto, which might be different than a detached home in London, Ontario. So we got to recognize that the situation will be different. But when we look at the overall price in Ontario, and that's why I always encourage people to talk to a mortgage professional, a realtor and so on, to see what their situation is. But when I look at that and I say, well, the average price in Ontario, say 5 years ago, was about 925,000, call it 900,000, in and around that range. It fluctuated throughout the year and started rising quite a bit towards the end of the year. And then, the average price in Ontario actually hit 1.1 million, believe it or not, in February of 2022. And that was the ultimate peak. But we're not going to go to that number. We'll use a number that before that. So call it 9.25. Yeah. When I looked at the Ontario Real Estate Association and I look at their data through CREA, which is the Canadian Real Estate Association, so far this year, the average price in Ontario is actually a touch under 800 now. It's 799, 750. So you're about 125,000, call it, less in terms of purchase price. And why is that important? Because even though interest rates have increased since the very low interest rates of 2021, because your mortgage is less, your down payment is less. If you're a first-time home buyer, your down payment, I worked it out to be about $12,500 based on those averages to be less. Your mortgage is going to be less. And because your mortgage is less, if we use current interest rates, your payment per month that I worked out is about $134 more a month, a little bit more on a fixed rate mortgage. Variable rate mortgages right now, they're variable though. Remember, they can change. Your starting point right now, prime's at 445. On a first-time home buyer high ratio, you can get prime minus 75, prime minus 80 right now. As of today, those rates can change, but as of today, your payment's actually a little bit less, about $250 less. But even if you take the $134, a little bit more per month, if you multiply that throughout the 5-year term, comes to about $8,000. Now remember, your down payment's $12,000 less. So your purchase price is less. And I always have to tell you a story about when I bought my first house. So when I bought my first house, what I looked at was a quality of life. My son was just born. It's 1996. He was born. I was living in a small apartment in Toronto, 1 bedroom. The crib was in the corner. So my wife and I said, you know what? We need more space. So I ended up buying a semi-detached home, didn't go big. I went with a semi, 3 bedrooms. So my son had his own bedroom, a backyard, close to schools, safe neighborhood, across the street from a park. You know what I mean? These are the things that I was thinking of. Now, I bought I closed in 1997 in February, I believe. And that was, for those of you that are out there that remember the early 90s, 1990, 91 was essentially a real estate crash. So I'm fresh off of that. And I'm not really overly concerned about, is my value going to go up? Is my value going to go down? Now, values have come down, to your point, which is terrific. 1.1 million average in February. We're far below that at 800,000, which is good news. But it's a quality of life. If you're buying your first-time home buyer, like I was, I honestly don't even remember what my mortgage rate was. What I did know, what's my down payment? Can I come up with my down payment? What's my monthly payment? What's my monthly payment relative to my rent? What's my improvement in my quality of life having a child and hoping to have another child, which we did down the road, making sure we had 3 bedrooms. Like, these are the things that I was thinking of that I think we need to get back to when we buy our first home as first-time home buyers. And of course, you got to be comfortable with that payment. You got to be comfortable with your down payment. It is a big investment, but I always say this, if you buy a house and you're comfortable with the payment and you're comfortable with the down payment and everything, down the road, take a 30-year RAM, your mortgage might be worth 0 and your house will never be worth 0. That I can make a prediction. I don't think your house will ever be worth 0. If you buy a house for $800,000 in Ontario, will that ever be worth 0? Probably not. But your mortgage might be. And even if your home doesn't change value or goes up and down, whatever, stays at $800,000 for 30 years, you have something, you have an asset, right? Whereas if you rent for the rest of your life, and you talked a little bit earlier about rent versus buy, you got to look at that scenario and say, okay, if I'm renting, what's my rent payment? And what could I buy? Even if it's a smaller house, like I bought a semi when I bought my first home to keep the payments lower and making sure I could afford them.
That's the power ownership, right? To your point, the value of the asset will never be zero. It's not like a stock paper.
A stock could go to zero. Your house, if you're
Yeah.
buying an $800,000 home in Ontario, I mean, I'm comfortable in making the prediction it's not going to be worth nothing. It might go down in value. I'm not saying it's going to go up in value.
Like
but we're at
now,
a time now where it has come down in value. Will it go down deeper? It might turn around a little bit. And hopefully we'll see interest rates, maybe on the fixed rate side, improve a little bit. But nonetheless, it's hard to say. But the bottom line to your point is that it is an asset. And every time you make a payment, you're paying down that debt on that house and you're building yourself some equity, which is, an asset. Equity is in your home.
Yes. With rents coming down in Ontario, Bruno, in some areas, does it still make sense to purchase these days?
There is a chart that I did look at, and it was like purchase rent ratio. And it has come down significantly in terms of ownership being more affordable relative to what the rents are. Again, every community varies. I mean, I live in Kitchener, Ontario, and I see some of these new rentals going up, and I see rents of, $3,600 a month. And in some of these newer buildings, what could you own for that? I mean, there is different programs. There's 30-year amortizations are available for first-time home buyers potentially. That can lower your payment. But, every community is different, and it's not that hard to work out. What are the rents? What am I paying in rent? You could be renting like I was a 1-bedroom apartment. I mean, I needed more space. So even though my rent might have been a little less than what it was to buy, the quality of life improvement plus the ability to own an asset, pay down my mortgage was valuable to me. But yeah, every market varies. But yeah, have a look at that. What am I paying in rent? And what could I afford to buy given the down payment and $800,000, call it purchase price? My down payment on the average purchase price, I have it worked out to $54,975. There are flexible down payment programs through the insurers that you can talk to your mortgage professional about and see if it works out. I mean, everybody's different. Everyone has a different risk tolerance. Everyone has different financial situation. Are you secure in your job? All these different things come into factor when you buy that house and making sure that you're financially stable, financially comfortable with the current payment. Because remember, if you take a 5-year fix, that payment's for 5 years the same. Rent might go up every year and so on.
Yes. Let's talk about the renewal cliff, the risk that many are facing in 2026. CMHC says that 1.15 to 1.2 million Canadian mortgages are maturing in 2026. And here in Ontario, we own a large share of that. So walk me through what this renewal wall looks like, that renewal risk looks like for homeowners and property owners. And what do they need to keep in mind and what do they need to do knowing that the renewal is up and their payment will likely go up?
So the good news would be that many of those mortgages that were done 5 years ago or even 3 years ago, because a lot of people took 3-year fixed, are coming due this year, were stress tested. So that means they were stress tested at a higher interest rate. So even though they might have got 2% 5 years ago, they would have been stress tested to 4% to be able to qualify. And you would assume, that on average, when we look at the average wages for permanent employees has gone up in Ontario and across Canada. I think today we got the average weekly earnings are up 3.4% year over year, and that's for February, and that's Stats Canada's numbers. So, you would hope people are making a little bit more money. Of course, everyone will say, well, what about food? What about gas? What about all these other expenses? What about inflation? We suffered through inflation through 2020. 2022, 2023, and we had very high inflation rates. But yeah, there is an increase in payment potentially. I mean, for the most part, if you got less than 2% 5 years ago or 2% on your mortgage, if that's what you got, and now you're coming up for renewal, again, I always encourage people, talk to a mortgage professional, let them know your situation. They'll go through your financial situation. We do have a record number of mortgages coming due this year. they can look at, doing what's best for you in terms of interest rates and so on. So talk to them, even talk to your current lender too. I mean, that's the advice I would give you, to say, what's the situation? What's my payment? What can we do? What are the options? You get the fixed versus variable, which I'm sure we'll talk about. That option is also potentially available to you. So yeah, if your payment goes up, I mean, it could be very, very challenging, especially if it goes up $600-700 a month, potentially on top of inflation and everything else. So look at that situation, talk to a mortgage professional, talk to your current lender, see if there's what the best situation is, in your current circumstances. It could vary. It's going to vary depending upon who you are and across the board.
Yeah, and that's a very important point for everyone who's listening. Your renewal, guys, is your opportunity to reassess your finances with your mortgage advisor and see where are the opportunities to maybe reduce your overall monthly cash outlay. Yes, on the mortgage itself, the payment may be going up because you're going into a higher rate. There is an opportunity to negotiate a better rate, but there are other things we can do to help you overall actually reduce the check that goes out of the door. Example is, we could potentially extend the amortization on the loan. We could look at your other finances, like Bruno said, and see where are you burning money, and can we take out any equity at a cheaper cost of money to help you, reduce the cost of debt overall, and you will be ahead. So don't get stuck on just looking at the rate on your upcoming mortgage renewal. And I invite you to have a conversation with your mortgage advisor early on. Don't wait for that paper to come in the mail and just sign it, or, wait last minute, because when you're reactive, you're not going to have many options. So thank you for that reminder, Bruno. Bruno, let's talk about the elephant in the room. There is an elephant in the room right now in Ontario with respect to equity compression. I read somewhere in, I believe it was a CIBC report, that Ontario and BC are at most risk of homeowners sliding towards negative equity if they purchased at the peak 2021 and now heading into 26. So that obviously compresses refinances, debt consolidation, equity takeouts. What could people do, if anything, knowing that that is potentially the path forward before the market stabilizes, if they have, equity right now or a renewal coming up? Is there anything proactive that they can do, knowing that this is, and again, nobody has the crystal ball, but it's a prediction. Is there anything they can be proactive about?
I mean, it all depends, again, on the situation. So, I mean, I have talked to some brokers, and they talk about what they call right sizing. So if you did buy a house in 2021 and maybe you bought a bigger one, a larger one, you did pay your mortgage down for the most part. So if you amortized your mortgage over 25 years, you might have paid $100,000 down off of your mortgage. So even though your value has come down, if you amortized your mortgage, obviously, and you took a mortgage that amortizes, some variable mortgages may have different amortizations. But overall, a 25-year basic straight up fixed rate mortgage that amortizes over 25 years, you would have paid your mortgage down. So that's the good news. Now, the right sizing, what that is, again, you can involve your mortgage professional. Maybe because the payment has gone up, it becomes very challenging. There is always that consideration to potentially consider. I mean, I'm not giving you this advice to say take it. I'm just saying consider. Mm-hmm. So I've been considering selling their house and then buying something much smaller, which they can go in at with 5% down, take on a smaller property. Remember, when I bought my first house, I bought a little semi. It was very small. It was like 1,200, 1,300 square feet, because that was what was affordable to me. So maybe you go from a detached to a semi to what they say right size, to put yourself in that better financial situation potentially. But you got to look at your overall situation. How much equity do you have in your property and so on?
Right.
But yeah, if every situation will vary. every situation is you got to be comfortable with, and financially and even, quality of life perspective. But the good news is you were stress tested 5 years ago. For the most part, most people, were stress tested. If you took on an insured mortgage, you were stress tested. So the increase in payment might have already been priced into that stress test in terms of what your payment is going up to. And again, to your earlier point, talk to your mortgage professional, go through the scenarios, go through your options. Everyone's different. Everyone might have different comfort levels. Some people might not even be bothered too much by the increase in payment. They might have already kind of priced that in, and other people might find it a little more challenging, but everyone varies.
The common question we hear about these days is, should I go fixed or should I go variable? Like, we know that the fixed rates have ticked up since the Iran war. Bank of Canada kept the overnight rate yesterday on April 29th as is. Predictions in Canada with some banks are showing that the rates will go up. In the US, they're saying they're going to cut. How does someone make a decision right now with respect to their mortgage? Do they go fixed? Do they go variable? What would you suggest as a thinking framework?
Well, the whole fixed versus variable argument has been around forever. And
Yeah.
it also depends on kind of the person and risk tolerance. I mean, can you afford your payments to go up? Are you comfortable if they do? Personally, I tell everybody I'm in a variable rate mortgage, but if rates go up, it's not going to really impact me over too much. My mortgage, thankfully, is not that big. So I can live through increases, and I'm not going to lie awake at night worried if they're going to go up or not. So, it depends on who you are from that sense. Are you comfortable taking a variable, taking advantage of the rate right now? And we'll talk about that on a high ratio perspective, being lower, but potentially going up. And are you going to be worried about it? You're going to lie awake at night? You're going to worry about it or not, right? If you're comfortable that it might go up and you're okay with that, that's a different temperament. But right now, when we look at the variable rate mortgages and we say, okay, from a high ratio insured perspective, meaning you're a high ratio, say first time home buyer, you're insured, you put in 5% down, you're buying a house, whatever, or maybe you're already high ratio insured and you're coming up for renewal. We talked about the renewal cliff, a lot of those mortgages coming due. I mean, right now you could get prime minus 80 on that high ratio insured. Now that's as of today, those rates can change or vary, but that's 365. Prime is 445. Bank of Canada is 2.25. 445 is prime. Variable rate mortgages are priced off prime. So if you get 80 points off of that, you're at 365. Right now, the high ratio fixed 5-year rates are in and around that 439 mark. Again, those rates could change too because of bond yields and everything that's going on with what we talked about, oil and so on. But as of now, 12:43 p.m. today, it's about 439 for a high ratio deal. So part of the rationale behind that is, if I do take a variable, if rates go up 3 times, a quarter, I'm at 440, which is in and around the 439 that my 5-year fixed rate would be. So that might add to the comfort zone of saying, well, you know what, even if rates go up 3 times, I'm still not, or I'm at the 439 I would have gotten on a 5-year fix. So you got to consider that. You got to look at, watch the CME Fed watch and say, hey, what are the predictions there? Am I comfortable? But again, if you just want a fixed rate, you don't want to be lying awake at night worried about interest rates going up or down. Because remember, a lot of people took variable in 2022 and then in even 2021, 2022. Remember, variable rates were very low, but then they shot up. They started skyrocketing. And, a lot of people weren't very happy that the interest rates were going up so much, but that's the risk you run. So a lot of people, majority of I'm going back then, a lot of people were choosing variable. You remember back in the day, and then rates started going up. Now, the good news is you can call your financial institution for the most part and lock in if rates start to go up and you just want to lock in, but you might lock into a higher rate than you would have been available to you if you just took a fixed. But from my perspective, again, I took a variable. Why? Because I'm comfortable. If rates go up, I'm happy. Looking at the situation as we discussed and so on, I thought a variable was best for me. But different people vary. Different temperaments are there. I mean, some people just want to have a payment. 11 years ago, when I bought this house that I live in now, I took a fixed. Why? Because 11 years ago, I could get 249 on a 5-year fixed. And I thought, you know what? I'm just going to take a fixed. Then I don't have to worry about it. When my mortgage matured 5 years later, I took a 5-year fixed. That was in 2020. So I bought in 2015, took 249 5-year fixed. When I matured, I got a 5-year fixed for guess what? 249. Some people would have said, oh, take a variable, take this, you know what? And rates did come down. They came down substantially. But you know what? At 249, I was happy. And then when my mortgage matured last year, I took a variable. So I've been kind of thinking about it back and forth. That's just my personal perspective. But I have been a fixed person because I thought 249 was a great interest rate and I was happy with that. So now I'm happy in my variable. But again, if rates start to go up and I feel like I can lock in, I can always call my financial institution and say, hey, I want to lock in to the fixed rate mortgages that are available to me.
Yeah, what I'm hearing you say is that it's really it's personal, right? Can you sleep at night? What's your plan for the property? These are primary drivers of rate.
And what are your plans for the property? Because a variable, you have typically in most variables, 3-month interest penalty, whereas in a fixed, you might have some IRD or 3 months interest IRD sort of things. So a variable can be more flexible too. So yeah.
Right. And for everyone who's watching, on the Streetwise Vault, we've put up for you guys a link to a video where we're talking about fixed versus variable in great details for 2026. And there is a chart there. It is not my prediction. It's not one person's prediction or an economist's prediction. It's just the chart that shows where the market is, what the market is thinking about at this point in time in terms of rate direction for both fixed and variable rates. And that is not set in stone. It is, at this point in time, data can change anything. But if you want to know what's the market thinking for the 5-year fixed and the 5-year variable going forward, and take that into account as you make your personal decision, then take a look at that link in the Streetwise Vault. Bruno, I've heard you end most of your talks with a line from William Arthur Ward saying that the pessimist complains about the wind, the optimist expects it to change, and the realist adjusts the sale. So for Ontario buyers right now and homeowners and investors, what does adjusting the sale look like right now?
Well, I think that we talked a little bit about it. When we look at purchasing a home, and if you're a first-time home buyer, how do you adjust the sales? I mean, back when the market was going crazy, you had 50 offers. People were buying, in some cases, sight unseen. No finance condition. There was the fear of missing out. There was no home inspection. Like, people were just wanting to get that house. Whereas now, well, how are we adjusting the sales? Well, I think from a buyer's perspective, you can be a little more cautious. You can shop around. Maybe you can negotiate the price. When I look at the stats, and I did pull them up here, and I say, well, residential months of inventory are pushing 5 months in terms of sales that are listed right now. So even though home prices have come down, the months of inventory is way above. The 10-year average in Ontario is like 2.5 months. It's now 4.5 months. So you have a lot of months of inventory. Active listings are above the 10-year average, but sales are below the 10-year average. So from my perspective, if you are considering buying a house, again, talk to your mortgage professional about affordability, get yourself pre-approved. Take your time, maybe adjust the sales by shopping around, maybe looking around at different homes. Certainly the market now is different than what in 2021 when there was that fear of missing out. Now, and you know what? You can get a finance condition, which I, obviously being in the finance industry, find critically important. Get yourself a finance condition to make sure that everything falls in line, because you are putting a deposit down and you want to make sure. I've always taken a home inspection, even though when I bought this house, it was fairly new, but I still got a home inspection. And even though I'm in the finance industry, when I bought my house, I got a finance condition as well in 2015. So back in 2015 to 2019, I kind of relate this market to kind of what it was. And it's funny because when I look at the 2019 data, I'm a data guy, I look at the sales were below the 10-year average in 2019 as they are now. The active listings were above the 10-year average as they are now. So you have a situation where when I look at months of inventory, a little bit higher than the 10-year average in 2019. So yeah, the situation from adjusting the sales is probably, a positive thing for first-time home buyers. When we look at average prices, to your point, coming down from those peaks of 1 million Ontario, 1.1 million February 2022, down to that what I got this year so far from the real estate board, 799, 800, call it. That's good news for potential first-time home buyers. But yeah, if you're coming up for renewal and you bought a house 5 years ago, then it's kind of challenging because you're basing it off of that purchase price in terms of being able to potentially refi. Again, talk to your mortgage professional, look at your situation. There might be things that you mentioned, a whole bunch of things that you can work with existing clients on, but certainly talk to that mortgage professional about your mortgage situation. And they might give you recommendations on where you need to adjust your sales. Based on your financial situation, everyone differs.
Yes. Bruno, where can people follow your work?
I typically, when I do my morning brew, my goal is to educate mortgage brokers in Canada. So if you know a mortgage broker, maybe they'll share it and so on. But from my perspective, my goal is to educate mortgage brokers on different things, the things that we talked about here today, keeping it basic, keeping it, understandable so they can talk to their clients and we can generally educate the public through mortgage brokers that follow my morning brew, as they call it. I have a mug here saying it's a morning brew, but I don't have it up in the public. I mean, again, if mortgage brokers are always welcome to use my stuff, because it's not trademarked. I always give credit to where I get my data. I use Trading Economics. That's a great website where I follow the Canada calendar, the US calendar, what's happening. I follow the Canadian Real Estate Association. When I looked at my data here, active listings, that's off of the Canadian Real Estate Association for Ontario data. So all my data is coming from, reputable, valuable sources. And then I consolidate it, share it in a simple way for mortgage brokers to understand, and mortgage brokers then to share it with their referral sources and their clients.
Beautiful. And folks will always share with you what we as professionals learn from Bruno. As you've seen today, he's able to deconstruct complex concepts into simple, digestible nuggets. So it is very, very helpful for everybody. If you've been watching, I want you to take some key takeaways from today. As you've heard Bruno, the economic indicators are not amazing right now. They're not, right? However, on the flip side of the coin, there is an opportunity. And the ground right now is fertile in Ontario. If you're looking to purchase a home, Bruno talked about how your payment for the same house is slightly higher than what it was in 2021, and you're buying a cheaper house, which translates into less down payment, less insurance premiums, less closing costs. That's an opportunity right now. It's a fertile ground. But for real estate investors, it is a fertile ground for investing. We're seeing cash flowing properties for the first time. And do you have to be cautious? Absolutely, you have to be more cautious because, economy is a little bit off, right? So you have to plan for higher vacancies. You have to do your diligence on the area. You have to build up your investment muscle. Gone are the days where you buy a property and a week later you flip it and it's worth more, right? At least for now. But it is definitely a fertile ground to invest or to buy. And if you have a renewal coming up, start early. As Bruno shared with us, there is an opportunity to look at the bigger financial picture beyond just the rate. The rate is just the tip of the iceberg, but there are other elements that can help you reduce your overall financial burden if you were to take that renewal as an opportunity to have a conversation with your mortgage advisor. Okay. And check out the Vault, guys, for the resources we talked about today. And lastly, I want to thank you, Bruno, for being here with us. I know your plate is full. Everybody wants to talk to you. So we are very grateful that you are here with us today and you've shared your wisdom and you deconstructed many complex topics for us today. Thank you. Thank you very much.
Thank you for having me. Appreciate it.
To everyone who's watching, I am looking forward to seeing you on the next episode. Thank you for being here today and stay streetwise.